right, ladies and gentlemen, and welcome back to another edition of the EFG Podcast. I'm joined in this one by my friend and colleague, Michael Cornips. Michael?
How are you going, Sam?
I'm going well.
Good to be here.
It's good to have you on. And we've got a special edition. Obviously, we don't want to kick people when they're down, but we thought we'd present some of our opinions on cryptocurrency.
Yeah, exactly right. I think we're all sitting there in a winter of discontent with the crypto space. We're watching the market deleverage. Other than the prices of crypto coins going down, we're watching a deleveraging episode. And I think, as traditional finance people trying to make sense of a fairly complicated world, I think there are 20,500 coins out there. I think the market cap of all coins are about $920 billion. It's complicated, and I think we'd like to just make some comments about what we see from our point of view, what's going on and the stability of that market.
Yeah, absolutely. I think we wanted to sort of say before that we're not experts necessarily on crypto. We do have knowledge in other areas of finance, and there may be some insights from our knowledge of other areas of finance that we can apply to the crypto space.
Yeah, I think so. What I see is there are two spaces in crypto. There's DeFi, which is protocols on chain that are rules based and doesn't need human intervention, and the other thing is CeFi, which is centralized finance on traditional exchanges or types of exchanges, relying on a traditional model, and crypto has got a foot in both camps. The preferred model would be DeFi, rules-based, no intervention, but we find a CeFi type of models in exchanges, relying on somebody else's trustworthiness to run an exchange or run a value of a particular product. So we're looking at it in the lens of a couple hundred years of financial history, and I think what we're sort of seeing is some aspects of crypto is not a lot different from the old banking runs of bygone days.
No, look, absolutely not. And you've obviously got your slide with a couple of the definitions there. Yeah. But one thing I wanted to stress, when I first heard about Bitcoin and then, when Ethereum came out, the things that attracted me to it were the decentralized nature of it, the rules-based system. And I think for most crypto enthusiasts, DeFi is the sort of thing that attracted them to it. And some might even say that it's CeFi that's led to some of the more recent problems.
Well, that's exactly right. And, there have been a couple of local reports where clients have owned some stable coins. They've pledged them across to a fund. The funds use those coins, paid the users 4%, but they've gone and pledged those coins to stake other applications. And, of course, when those stable coins, as it turned out, those stable coins fell in value, clients have lost a lot of money. So it really is trying to, as you say, it'd be great if it was all rule-based DeFi, but I think we're seeing a traditional bout of the centralised finance problems.
Absolutely, and ultimately, it's as you say, the same problem that has popped up in more traditional finance for the last few hundred years.
Yeah. So the big accident, I think, what happened was when Terra. It was running a stable coin. It used a Luna token to, rather than a stable coin being backed by, treasury bonds or commercial paper or something like that. It was actually an algorithmic stable coin, and the protocol, it was in the DeFi space. The protocol basically bought and sold Luna to stabilize the price of Terra.
Yep.
And but being algorithmic based and not having traditional fiat currency securities, it broke the dollar unit value. And of course, a stable coin at 99 cents is an indication it's going to go to 98, and then after 98 it goes to nothing.
Yep.
Because it loses all faith and confidence. So Terra went from a very big market cap, I think about 30 billion, down to close to zero. Mm-hmm. And but then there's been consequential losses from there.
Absolutely. So the Luna coin itself was very, very high, and it's now down to fractions upon fractions of a cent.
Yeah.
There's now trillions that have been issued because obviously the algorithm kept minting new coins.
Correct.
I think they've stopped it now, and it's at several zeros below $1.
So let's just look at a couple of stats first, and maybe we can dig into a bit from the pure numbers. Mm-hmm. Just going on to the next slide, what we've done is looked at the value of the stable coins. You can see that a red chart there, the chart with a red line. So it's sort of gone from near zero. It got up to quite a large market cap, and you can see the market cap is now turned around and is hit about $70 billion. Mm-hmm. And then what we've tried to do with the table is just show how much liquidation has occurred, especially in the Tether stablecoin. So that was back in April, 82 billion in assets, and on the 6th of July, yesterday, it got down to around about $66 billion. So basically, about 20% has been cashed out, mm-hmm. has been taken off the chain. So Tether is the main coin used to trade Bitcoin. Yep. And I think about 80% of Bitcoin turnover is done through Tether. But this is just a sign that people are getting out mm-hmm. of these stable coins. Just taking those 4 stable coins. Overall, you can see the 4 have lost about 10%. Yep. Which annualises about a 40% annualised loss. You might think annualised is not a clear picture, but what we are watching on a daily basis is a trend. What I tried to do with this on the top graph is just show that we've gone from 200% growth in stable coins, and we're down to that close to that 38-40%. Negative growth on stable coins being issued, and again that same graph there.
Absolutely,
yeah.
And we'll touch on this a bit more later, but this for me is the easy exit liquidity from crypto.
Correct.
So if you're a large holder, I think in the crypto space they're often called whales, and you're wondering whether you should cash out. The door is starting to close potentially. Yeah. And we'll touch on that a little bit more in a moment. But obviously the total stablecoin market cap, the more that goes down, the more worried you might be.
Well, the thing is, the system is losing liquidity. What's happening is the system is deleveraging, and we'll just look at a few DeFi stats in a second. But so Tether years ago was pretty much debanked by every bank in the world, and I think it's ended up with banking with a bank in the Bahamas, and it claims that its coin is backed by it did claim it was backed by US dollars Treasury securities, but after a bit of prodding and auditing, they've discovered that yes, a good portion is in US Treasuries, but there is also commercial paper, mm-hmm. And I think there's some loans in there. So I think you just touched on it then, is that if you've got 80 billion in assets backing your coin, and the bottom 20 billion, let's say, is junk, the first people to cash in
are going to cash in, the treasuries and the very liquid stuff.
And the very liquid stuff. And therefore, it makes the whole equation, as the bank, people are cashing in, it makes the whole system less stable.
Oh, absolutely. And, all of that debt that they would have purchased, during the bull run to back their stable coin, the face value of all that debt has now fallen. We've had interest rates rise, we've had yields rise, and as those yields have risen, face values have fallen, and as a result, what they paid for that debt, it may no longer be worth.
And that's reflected in if they bought triple B paper, or even triple A paper, they've all gone up in yield. But if you look at the yields on junk debt, they've gone from 3%, it's gone up to 5.7%. Now, even if you're holding short-term paper, you can easily lose 10 or 20% of your capital just in the credit deteriorating. And I think there was a rumour that Tether did own maybe some evergreen bonds, the Chinese company. Whether that's true or not, the point is it has some commercial paper and doesn't publish that. So there is a question mark about it. But again, I think we were talking before, the problem with the stable coins backed by fiat currency, US dollars or A dollars, really means that they haven't got outside of the system that we're in at the moment. And I think the purist would really want a stable coin that was backed by another crypto. Now, I think we're a long way away from that. But the fact that we're relying on value in the stable coins being proven by US dollar assets means we haven't left the system.
Yeah, we're still in the building.
We're still in the building,
as you say. I did just want to just take us back a little bit, and I wanted to say that whenever you've got an asset that's at a fixed price, in this case Tether, $1, and it's backed by other assets that are at a variable price, there's a risk there. And Tether's obviously fairly large. They've got a fair amount of liquidity in the form of all these debt securities. But if someone big enough and bad enough comes along, there is the potential that they can trigger a depegging. And I think that's a real risk for the crypto space, especially because, as we saw, with the current deleveraging, they're selling down the very, very high quality, most liquid US government treasuries. The stuff, when they get to 50 billion or 40 billion, the stuff that's left is not going to be that liquid necessarily.
Exactly. And we've witnessed that in the past, and especially in the crypto world, where if there is a fault in the protocol, it is exploited by the crypto players,
absolutely.
Don't they? I mean, they love it.
Even going all the way back to the early days of Ethereum and the very, very first decentralized organization, the very first DAO, someone figured out the flaw and sent all the Ethereum to themselves. And
if the fault can be exploited, it's going to be exploited.
Yep.
And so we have Michael Saylor out there in the
Microstrategy.
Microstrategy, forgot that name for a second. Now, people are going to say, well, look, if the Bitcoin price keeps on falling, they have 130,000 thereabouts Bitcoins. And I think he's put out his quarterly result and he's lost a couple of $1 billion. But the market says, at what price will a MicroStrategy have a margin call? And we don't know what price that is, if there is a price, but if it's $10,000, that's where the price is going, because that's where it can be exploited.
Yeah, exactly.
Soon as the market. So this market needs to go to the price where there's no more leverage to be squeezed out of the system, and then possibly they can build from there.
Absolutely.
Yeah.
I think another thing that crypto purists didn't expect was synthetic cryptocurrency brought about by crypto derivatives and things like that, which we've seen in traditional asset markets like gold, but you can have a lot more selling than people willing to part with their bitcoins.
So what we've done, we've polluted what we want as a pure DeFi rules-based system, and we've brought in this old futures trading, and we know everybody knows what they've done to the price of gold. They've suppressed it, of course. Us gold bulls would say that. So why would you let a traditional instrument come in and potentially suppress a crypto asset like that? And that's why it needs to go to DeFi on chain.
Absolutely. So do you have information on staked?
Yeah. So I had a good look at the on-chain DeFi protocol, and there's a couple of websites that monitor the total value locked up in DeFi. So this is where people pledge their assets into a protocol, and rules based, and you can see if it's what they call total value locked into the protocol, and you can see the massive growth in these protocols. You know, you got to 250 billion, but now you can see because of that Terra deleveraging event, a lot of leverage has come out of all the DeFi protocols combined. It's come right down to $70 billion. Now I'll say that that isn't lost money. That's just people moving away for safety reasons. People would have just got their money back and just said, "Listen, we're not playing this DeFi space." But that is a massive deleveraging. And if we just I'm just looking at the top 8 protocols. And there was 1,500 protocols in that number, but the top 8 you can see it's a similar pattern. It got over $100 billion, and that's now fallen all the way down to $38 billion. So again, it's just a massive deleveraging event in the DeFi space.
Absolutely. So I guess in terms of the future direction from here, you'd have to say a lot of this is destroyed confidence in the very aspects that pushed crypto to its highs of 2021. And without those things in place, these market caps, these prices could easily continue to drift. And with money being catched out of the stable coins, some of them may become more vulnerable to, attacks.
Yeah, and I think anything that is CeFi, anything that's centralized finance, anything that relies on old technology where you're trusting somebody in an exchange, I think that's something that can come under threat. It's unfortunately, crypto is like the old banking system, but without a reserve bank. And if we go back to the GFC, the money market funds back in 2007, 2008, they held the value of $1, which is the same as a stable coin, and it broke what they call broke the buck, because there wasn't enough liquidity to pay redemptions, and selling of very good A-grade paper pushed the price down, and the system went into hysterics because it broke the dollar. But then the Reserve Bank came in and saved the value and had to restore the confidence on those money market funds, had to restore the unit value. We haven't got that protection in crypto.
No. And a wise man once said to me, there's no such thing as a credit crisis. There's only liquidity crises.
Correct.
And I'd be worried about the liquidity for stable coins and anything dollar denominated, any exit liquidity for the crypto space in general.
Correct. And in essence, we've even seen it similar behaviour. Like take Japan at the moment. What it's trying to do, it's trying to hold the 10-year bond rate at 0.25%, or around 0 plus or minus 0.25%. It's trying to hold that value. So it's trying to artificially stabilise their 10-year bonds at that rate. Now, unfortunately, the currency then becomes the balancing item. And what's happened to the yen over the last several months? It's fallen 35% in value against the US dollar. So Japan is trying to protect a bond rate. It can't protect the bond rate and the currency. You can pick one. So it's just what the point is. It's just similar behaviour in the financial markets, trying to protect a peg, and the Japanese currency is paying for it. and you may recall, same thing happened with the Swiss franc.
Mm-hmm.
The Swiss government was trying to protect the currency,
Mm-hmm.
and eventually it was broken.
Mm-hmm.
The peg was broken. And again, a similar thing, if you go back to George Soros on the
pound.
And the pound.
Mm-hmm.
The pound peg was broken as well. So any pegs are made to be broken.
Yep.
And the industry, as we keep saying, needs to move to a rules-based
Mm-hmm.
type of stable coin, where people have confidence in it and confidence is built. And we must build a independent currency system away from traditional finance. Otherwise, what we're really doing is just traditional financial instrument dressed up, calling them crypto.
Yep, absolutely right. Absolutely right. So, look, crypto winter.
Crypto
Still cold.
it's still very cold.
Yep.
And I think with crypto hanging around that $20,000 mark, I don't see how it's going to turn around in the short term. I have a complete belief in the concept, but I think this deleveraging needs to happen, and it'll have another go. That may come back, but then eventually I think it will find some credibility.
Yep, and I don't disagree with that. And like you said, what is attractive is the decentralized rules-based nature, and if they can get that right, that's very, very exciting, very, very appealing.
Yeah. It'll work when you'll be able to buy a cup of coffee with Bitcoin. It can't work if you're buying a cup of coffee with Bitcoin, which is cashed out of Australian dollars. It must be, the transaction must be in the underlying crypto. You buy a house in the underlying crypto. You buy and sell. You don't say, oh, geez, I'm rich, I've got $1 million. I'm rich, I've got 100 coins. It's when people say base their wealth in the coin is when this has a great chance of success.
Absolutely. Interestingly enough, you mentioned Microstrategy before, and way back in the .com bubble, it was one of the ones listed as extremely overvalued, and it fell off in that big crash dramatically. I think it lost over 99% of its value.
Yeah.
And it's come back from the ashes. Well, are we going to see a similar thing happen to the crypto sphere itself? And
well, that's right. Yeah. Well, they prior to the Bitcoin purchase, MicroStrategy was around about $123 a share. It put on about $1,000. I think intraday it peaked at $1,500. It's under $200, back under $200 now. And they've got 130,000 Bitcoin at $20,000. That's $2.6 billion. I think they paid around $30,000 for it. Yeah,
it's somewhere between 20 and 30 as the average.
Yeah, I think
price.
it's about 30 or 20, 28, but they've dropped about $1.3 billion. His problem is that he's issued convertible notes to buy a good portion of it. Fortunately, the convertible notes convert into equity, so there's no margin call on that. But he did borrow money on a straight debt issue to buy some coins. But unfortunately, if Bitcoin goes down to $10,000, $5,000, that company, people will just presume the worst, I would have thought.
Oh, absolutely. All right, well, a cheery note to end it on.
A very cheery note, I thought.
Yeah, it's still a bit of a rough ride, I think, for crypto, that deleveraging situation you talked about, and, that these things take a bit of time to work through, so I don't think we can call the bottom here yet, but definitely something to keep an eye on in the coming period.
Absolutely.
All right, guys, we're going to wrap it up there. Hopefully you've enjoyed. Hopefully you got something out of this session. If you have anything to comment or if you have any questions, let us know down below. And we'll see you guys in the next one.
See you next time.